Welcome, Life Wealth family. This is Hilgardt here again from the Captain's Chair, giving you an update to the skinny on what's going on in the world and in the markets. A lot of noise, as you've known, in the last week or so that took place as a result of the banking, I would say not even crisis, but hiccup is probably a good word. Excuse me. The Fed did increase interest rates by 25 basis points, 0.25%. We're planning to increase it by 0.5, but because of what was happening in the banking system through Silicon Valley Bank and through the Signature Bank and with Credit Suisse internationally, they started seeing that the increase of interest rates are creating more and more stress for the banks because banks normally hold long-term bonds. And bonds and interest rates have an inverse relationship. So as interest rates are going up, the price on bonds are coming down. And so the continuous increasing of interest rates from the Fed side is putting pressure on the value of the assets of banks. And that's why the Fed backed off and only increased interest rates by 0.25%. Inflation is still high. It's in the 6% range still. And so the target for inflation would be, has been 2%. And so what we've seen as a result of the Fed now wanting to continue to go after inflation, but be careful about doing so, is we are seeing them kind of pausing on their increases or the rate of increases. So from this came a lot of charts and speculation relative to how the Fed will react as a result. So here's a few things that we can see pretty much this year. You've heard me say this, that I believe there's a very, very high probability that we will have a recession. Again, a recession is 2 quarters of negative GDP growth back to back. It looks like that could be occurring maybe around about September. But we're definitely heading in that direction. I have a few slides today, and so as you can see on this first slide, we do have a disconnect between what is expected from earnings and earnings season for the rest of the year. On the chart to the left, you'll see there's an expectation of corporate earnings to go up, but at the same time on the right-hand side, you'll see a chart just as to what the expected GDP growth is. GDP is just gross domestic product. It is an indication of total economic growth. And so these two charts are just not really speaking to each other. And so there's a pretty strong disconnect here of the expectations of companies' earnings versus where the economy is going as a whole. Something's going to have to give inside of this type of picture. We'll start seeing this next week. Beginning of April is the beginning of earnings season. This is where companies comes out with a first quarter earnings reports, and we'll start seeing how things will be happening. So if there's anything that we are quite certain about, it is that we will have a recession this year. The bond market is is already reacting in such a way that the 2-year Treasury yield has dropped substantially. And that is an indication of the bond market saying that they highly, highly suspect that the Fed will cut interest rates for the remaining part of this year. And the reason the reason the interest rate on the 2-year drops so much is because they see that as less enough an opportunity for interest payments because they anticipate the Fed bringing the interest rates down. As the Fed levelizes interest rates or even then starts reducing interest rates, I believe that the stock market will have a positive reaction to that. It will kind of start signaling that maybe a halt or the stopping of interest rates increasing. We still have to see how these things are playing out. The real life, the real recession, the real economy is a little bit of a tail reaction. The stock market is constantly trying to be 6 months ahead of where things are. So we see the banks are having some trouble at this point in time. The question is, are we going to have future companies have troubles as companies are going through the recessionary period of time? And perhaps, as you can see on this chart, we're seeing that a lot of non-banking institutions are creating a lot of capital for companies at a lower cost. And, about 2, 3, 4 years ago, now it's at a higher cost. If there's defaults, it might be happening in the area of private equity. It might happen into institutional investors investing in funds that have been providing corporations funding in order to grow. So all to say, we anticipate the economy to be under pressure. We anticipate some companies or some weaker companies to possibly fail, and we don't know what the government's going to do. We can see by the reaction of the government on these two banks, then stepping up and securing depositors over 250,000. That's pretty significant. There's a little bit of an issue with that. I think it reminds me of the period of time too big to fail in the 2008 period of time, where the government steps in and not allowing free market forces to play out. So we are concerned about that because it means that people can continue to make irresponsible decisions without any consequences. So there's a lot today for you. We'll be watching very clearly and carefully. We still see two major opportunities through market indications this year. We're starting to see our yield portfolio now yielding in the vicinity of 9%. As interest rates in the future come down, the bond prices will go up. It's really good opportunities to look at the yield portfolio, in my opinion. So great opportunities I could see. We are helping more and more people that have big questions as they are reviewing what they're currently doing. Maybe they don't have a proactive advisor like myself talking to the family. So please keep us in mind when that conversation comes up with your friends and family members. We'd love to connect, and we can schedule a 15-minute introduction phone call. And then from there, we can help give a very thorough second opinion through our impact analysis. Great to be with you this morning again. Enjoy the beautiful weather and the great remaining days of our spring until it gets real hot here in Florida. Have a great rest of the week.